Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CINEMARK Holdings INC quarterly report. CINEMARK Holdings Inc. offers a range of businesses and services including motion picture exhibition theater operations in the United States, theater operations in Latin America. CINEMARK Holdings Inc.'s stock price drop. A year of challenges over the past year, CINEMARK's stock price has experienced a general downward trend. The company's stock was down 5.29% as of May 2025 and fell approximately 15% by October 2025. Several factors have likely contributed to this negative performance. One major issue is CINEMARK's consistent missed earnings per share (EPS) estimates in recent quarters, including a 16.67% miss in Q3 2025. Additionally, the company has faced year-over-year revenue decline and challenging comparatives due to strong box office performances in previous years. The broader industry also faces macroeconomic pressures affecting consumer spending on entertainment. The most significant drop of 7.2% occurred on July 9, 2025, but the specific news event causing this drop was not detailed. Overall, CINEMARK's stock price has been impacted by a combination of missed earnings estimates, revenue decline, and industry challenges. The primary drivers of revenue growth or decline in the given financial summary are largely influenced by the box office performance of new film releases, volume of new film content available, and success of blockbuster films. The data shows that a significant increase in box office revenue, film rentals, advertising revenue, concession supplies revenue, and salaries and wages revenue contributed to overall revenue growth. On the other hand, declines in admissions revenue, concession revenue, and other revenue were attributed to factors such as seasonality and timing of payments to vendors for expenses. The success of blockbuster films like Minecraft Movie, Lilo and Stitch, Superman, and Jurassic World Rebirth played a crucial role in driving revenue growth. The U.S. segment experienced significant revenue growth of 18.6% compared to the international segment's modest growth of 0.3%. Overall, the performance of new film releases and blockbuster films emerged as key drivers of revenue growth or decline. Net income and profit margins decline. A summary of the financial performance. The financial performance of a company has taken a significant hit in Q3 2025, with net income decreasing by 73% compared to the same period last year. This decline is also reflected in the year-to-date (YTD) results, where net income decreased by 59%. The decrease in net income can be attributed to various non-cash items, including a loss on warrants and impairment of long-lived assets. Profit margins have also taken a hit, with operating income margin decreasing from 17.7% to 13.3% in Q3 2025. Net income margin has decreased even more drastically, from 20.4% to 5.9%. The adjusted EBITDA margin saw a decrease of -19.7% in the first 3 months, but increased by +2.8% in the first 9 months. The increase in operating expenses, such as depreciation and share-based awards compensation expense, has also contributed to the decline in profit margins. These factors have had a significant impact on the company's financial performance, highlighting the need for adjustments to be made to improve profitability. The company's financial performance indicates a consistent generation of positive operating cash flow over the past 2 years. In 2024, the company generated $269.6 million in operating cash flow, while in 2025 it produced $248.3 million. These figures are further confirmed by additional pages, solidifying the conclusion that the company is successfully producing positive operating cash flow. The company's debt level has undergone significant changes over the past period. While the current portion of long-term debt decreased substantially from $464.3 million to $6.4 million, the long-term debt, less current portion, increased slightly from $1,870.4 million to $1,869.6 million. However, total long-term liabilities decreased from $3,183.8 million to $3,146.6 million. In terms of interest expenses, there has been a mixed trend. Interest expense decreased by $4.5 million from 2024 to 2025, but incremental interest expense increased by $16 million for the 9 months ended September 30, 2025. The cash paid for interest by holdings in CUSA also increased by $3.9 million and $2.9 million respectively. The repayment of $460 million principal of 4.5% convertible senior notes in 2025 has likely contributed to the decrease in total long-term liabilities. Overall, while there have been some fluctuations, the company's debt level and interest expenses have not changed significantly over the past period. The financial performance of the company's segments and regions varied significantly in 2025. The U.S. segment stood out as a strong performer, with revenue increasing by 15% to $857.5 million over the 9-month period. Attendance also saw a significant boost, with an average ticket price increase of 4.6% and concession revenue per patron rising by 4.5%. In contrast, the international segment struggled, with revenue plummeting from $180.4 million in the first 3 months to $2.3 billion over 9 months, largely due to unfavorable exchange rate fluctuations. Despite this, North America emerged as a bright spot, generating $6.7 billion in industry box office revenue, a 4% increase from the previous year. Management's outlook and strategy. The company's management is optimistic about its future prospects despite the current financial performance. They believe that their existing cash reserves and expected cash flows from operations will be sufficient to meet their financial obligations for the next 12 months and beyond. To fund capital expenditures, they plan to utilize various sources, including cash flow from operations, borrowings, debt issuances, sale-leaseback transactions, and sales of excess real estate. Management is focused on managing the company's financial performance by reducing debt and maintaining a stable financial position. They have already repaid $460 million principal of the 4.5% convertible senior notes and settled warrants, indicating their commitment to debt reduction. Additionally, they plan to continue paying quarterly cash dividends and repurchasing shares through the share repurchase program. Overall, management's strategy is centered around maintaining a stable financial position, reducing debt, and investing in growth opportunities, while continuing to reward shareholders with dividends and share buybacks. The company has demonstrated a commitment to returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $29 million in total, with quarterly distributions made throughout 2025. Additionally, the company repurchased up to $200 million of outstanding stock between March and March 2025. Furthermore, the company issued new shares as part of debt repayment, totaling approximately 19.6 million shares. These actions collectively indicate a proactive approach to shareholder value creation. That concludes the financial summary for CINEMARK Holdings INC. Feel free to comment below, and I will be happy to answer them when possible.